Welcome to Zen and the Art of Real Estate Investing, one of the fastest growing real estate investing podcasts in the world. What if you could learn from experienced real estate investors? Find out what got them to where they are now. Get insight into their daily habits and take these insights to inspire your own growth. Each episode, Jonathan Greene shares an in-depth look at the mindful approach to real estate investing. Jonathan is a lifelong real estate investor and the founder of Streamline, a data-driven, investor-friendly, independent real estate brokerage located in Madison, New Jersey. Whether you're looking to start from scratch, get to the next level, or just for a straightforward and honest approach to real estate investing, this is the free mentorship program you can take with you anywhere. Now, here's Jonathan.
Welcome back to another episode of Zen and the Art of Real Estate Investing. My guest today is Aaron Marsh of Marsh Lending. I guess you figured it out. This is going to be a lending show, and lending shows are here to help you figure out how smarter financing leads to better real estate deals. We're talking DSCR, no docs, and a lot of different options with Aaron right now. This is episode 361 of Zen and the Art of Real Estate Investing with my guest, Aaron Marsh. Aaron is the president of Marsh Lending, where they're dedicated to delivering seamless, customizable mortgage and lending solutions that meet the demands of today's dynamic personal and commercial markets. And P.S., they're focused on a lot of investors. Aaron, welcome to the show.
Hey, thanks for having me. I really appreciate it. It's going to be exciting.
Yeah, I'm excited to talk to you, but I want to go way back because I grew up with a dad who was a real estate investor. So I was always in real estate as a kid. You got the real estate bug originally from your grandmother. Am I right about that?
Yes. Yeah. So she opened an office for Ebby Holiday back in Dallas in like the early 70s. And so then she got my mom involved in it. And so my mom and my grandmother, back then there was no internet. So
I
she
remember.
would get a contract or a listing agreement or something like that. And then we'd hop in the car and she'd drive over to one house and they would sign it. And then they would drive over to the other house and they would sign it. And then they would take it and go to the title company and or the lawyer's office and kind of do all that. So I was a kid in the background, and all I just knew is, if we got both signatures, then I got like something out of it, like ice cream or
that was my life. Yeah, we used to go collect the rent, and then we would go right to a diner, and I would get an ice cream sundae. I'm like, this is great, or get a video game. I'm like, this is the best stuff ever.
Yeah. So that kind of got the bug started, and then my family, they had some real estate holdings and some property as well, and then I went to college, and then I got into corporate America, and then I was in finance and operations forever and took all those learnings. And then when I wanted to get back into real estate, specifically from a real estate financing side, I kind of brought all that with me, all that exposure.
Yeah, I don't know about you, but like for me, I was always investing my whole life. But then when I got my real estate license and then I started doing this and I started like investing more as an adult, even though I invested a lot over the years, I realized that all the times I was just sitting in the car, I actually learned a lot. It's almost like even as a kid, you have like all of these osmosis memories of, like you were saying, you're going and you get the signatures and then you realize not as much has changed as people think. Do you agree with that?
I agree. Yeah. I mean, you can automate a ton of stuff, and in the business that we're in, a lot of our closings are virtual, right? So they're notary, they're mail away, or we have a mobile notary that's getting to those clients because they don't physically live here where they're buying the investment property. But at the end of the day, it still kind of comes down to a bunch of documents. They need to be signed. It has to be all correct. There's a lot of human intervention in some of that, whether it's digital or wet signature, and it all has to come together.
Yeah. And I mean, especially on the lending side, there's a lot of moving pieces. There's a lot of what I would call user error on behalf of clients. Like a lot of people look at it and they think, oh, the lender's so slow. And it's like, well, I've been asking the client for documents, for 3 weeks, right? So, I mean, I think there's misconceptions about every part of real estate, including lending. Have you found that?
I agree. And every kind of level in the vertical part of the transaction thinks that they're always to get to blame. But for us, we always think that anything that happens, it's the lender's fault, right? So why is title getting, why aren't they getting beat up, or the homeowner's insurance company because they haven't got the pages that we need back to get the deal closed or get it through underwriting, right?
Yeah.
Oh, the lender's taking forever, the lender, and it's really, there's a lot of pieces that we're trying to quarterback that aren't really our pieces, but we're taking the bullet for it.
Yeah. Before I get into one longer question, I'm just curious, like, has lending become a little bit harder with the advances of AI in terms of like documentary fakes that people can make? I know you're going to like verify all of this information, but I know for landlord things have got harder, and I've seen stuff, fake pre-approvals and things like that. Is it getting harder, or have you developed systems that kind of, still are able to vet all the information?
We do a good job. We kind of pre-underwrite a lot of the stuff that we have, because there's two parts of it. One is we have a lot of times our business, how we get the client is through a referral. So if they're working with a realtor partner that we respect and we work well with, then we want to make sure that we're doing everything, and then we're letting them know, hey, this client is really pre-approved based on what they've given us and what we have been given it, we believe and deem to be accurate and honest, right? And because we don't want to harm that relationship, because then the realtor can come back and go, you gave this guy a pre-approval and it's on fake documents or it's on garbage information and you didn't proof any of it. So we try, and as part of our process, we do a lot of digging, a lot of discovery, and you can tell in some of those questions when you're asking them, hey, what about this? And then we'll ask them for a PFS or something, and they'll send us a PFS that was written with a crayon on a napkin. Like, hey, this is great. We can use this to just kind of get the conversation started, but we need actual documents. We need statements. We need all the pages of the statements. We need, all of the things that we need to kind of, make sure that when we then turn over, because we don't want to burn the bridge on the other side, right? We don't want to burn the bridge with a lender saying, hey, please underwrite this. And then it comes back, we wasted their time, our time, if it's not there.
Yeah, I think the pre-underwritten strategy from lenders is way not focused on enough. It can give so much advantage in competitive markets right now, but it does take more due diligence up front from you. So you kind of need that information from them, especially if you're doing DSCR. You need the income information on the property to be able to get it. But don't you find that being able to kind of pre-underwrite, they're going to be steps and steps ahead of a lot of other people who might be offering on competitive properties who just went on a site or they talked to their friend and got a very loose pre-approval.
Yeah. And I think if you can start to make a name for yourself that your pre-approvals are pretty good, they've got some weight to them, then that offer, when it comes in on the sell side, your offer will get picked over, let's say there's 2, 3, 4 competing offers. And like you said, if some come with a loose pre-approval, but ours comes with a very strong pre-approval, more often than not, that helps our clients get their offer, as the one picked.
Yeah. And I mean, that kind of dovetails into something we were talking about before of just kind of the relationships of all the parties. But like for me, if I'm on the listing side and I call all the lenders of people who are close, and or text them and see how quickly they respond. And if they say, oh yeah, they're good to go. And yeah, I do then know who I can rely on. I see them again on a pre-approval. I'm like, that's rock solid. Like I know what their pre-approval means versus others. And I think again, that it takes time, but I think a lot of people on all sides of the transaction, they may not know that. And a new investor may not understand that it's better to work with a verified lender who's done loans like this, especially when you're talking about investor loans, because maybe they think they can just go, hey, I'll just go to, Chase and I'll get a DSCR on a short-term rental. Like, okay, good luck with that with Chase. That's going to be impossible.
Right. And a lot of times they'll do some searches, or they'll ask their chat, or they'll try and vet out a few resources of capital for this. And on the ones that come back really quick, oh yeah, we can do that, really trying to make it easy on the front end just causes a lot of problems down the road. But if you can do some of that pre-vetting, getting some documents in early, understanding, what is the most strategic and best, lending product to put this customer in for what they're trying to do, or this client, that's a little bit more work up front that they may not like, or other competing lenders may not have them put through those paces, but it smooths out a lot of the stuff downwind, because then we can quickly get into ordering an appraisal, getting the inspection done, get into the due diligence, all that kind of stuff.
Yeah, that's just going to make a smoother transaction. I agree. Not, less vetting up front means more problems right at the start. And that's not good for anybody. It's bad for the seller. It makes it look like there's a problem with the property when it was just, something that occurred before. Doesn't help the buyer move fast in a competitive market where you really need to get get this thing moving, because there's other people who are just going to keep upping their offer until they beat you. So I think new investors and new people who are just looking into lending, especially for investment properties, really need to know it does make a big difference, and that goes to the whole transaction.
Yeah. And especially if it's like from your standpoint on a sell side, if you know that your property is attractive and there's multiple offers on it, you could get into a situation where you are in a bidding contest. You want to make sure that, you win that, right?
Yeah.
And that you are upping your bid, and that a lender on our side can do what we're coming to the table with, right? We can bring the bag of money.
Yeah.
Right. There's a lot of deals that fall apart, especially on the commercial side, where they say that they can do all these things. And in fact, they'll take money from you. Yeah. You pay us 10 grand, and then we'll put together all of this stuff, and we'll think about, sending it out to our partners, and then they just ghost you. Right.
Yeah.
Whereas we're a little something different. We want to make sure that we have that great client journey, satisfaction for them as well.
Yeah. Don't you think one of the biggest misconceptions for investors is that there's like a limited amount of investment lending that you can get? There's a lot of different strategies out there. And I know that's one of your specialties at Marsh Lending, but don't you think it's just not something that a lot of newer investors or even seasoned investors really know, that there's a few different products out there that you can figure out that work for different types of properties?
Right. And that's part of our process, is like the discovery call. So we'll get in. Let's say you're the client, you pick up the phone, you heard about us, or your broker referred you to us, or a friend or someone else. And then we'll start that initial conversation. How are you? What are you trying to do? Tell me about your goals. What is the end game that you want with this property? Because all of those things matter. Then we go back to our team later that day. We put together, who we think of our curated best lenders would, be the right strategy for you, right? So like, let's say that you only want to you're going to buy this property, you're going to do paint and pillows, and you're going to rent it out for 36 months. And then you plan on selling it, right? Exercising, that appreciation and property value. Well, maybe a good product for you would be like a 3-1 ARM, right?
Yep.
Right. Cause then you're going to get lower rates now than what market is. And then you're only going to hold it for 36 months. And then if you want to refinance it because it is becoming a passive income cash cow or something like that, you can. Or if you're going to put it on the market, you're not locked in, right? So a lot of those kind of ideas come out. Or it might be a situation where, no, I'm going to buy this, I'm going to hold it long term, and I'm going to turn it over to, my kids down the road or something like that. Well, then maybe a 3-1 ARM isn't the best product. Maybe we get you into something that's a little bit longer term with the ability to refinance if, a market says so.
But that's really important, because I think investors need to know their why. They need to understand why they're doing it. And if they don't, they're putting you at a disadvantage in terms of what you can really bring to the table for them, because they don't know, and then they're going to tell you later, oh, that's not what I meant. How could I get an ARM? I'm going to hold this forever. And then you go back to your discovery call and say, actually, no. And of course, things can change. But I think that the strategy, with ARMs and shorter length, I wouldn't say it could be risky for some, but like in most residential properties right now, I feel like rates people think they're high. Historically, they're not high. But I think like you could get lucky. So in 3 years, rates could be down again. It's like a different way to look at it now.
Yeah. And that's the best way to think about an arm. Everybody thinks about an arm or
Only going up.
going the wrong way. Yeah. Right. Oh, I don't want it to go up in 3 years. I want to keep this rate. Well, what if it goes down? Then it's to your favor,
Yeah. Yeah. And also, like, even if you had you had something that was longer, higher, but a shorter term, we're looking at a potential where rates could be down a little bit or the same. It doesn't look like they're going to drastically be higher in 3 or 4 years. So you could at least refi into something better at a time along the way. And that's why, like, over the, after the pandemic, when rates went up, a lot of buyers will say, oh, I'm going to wait it out. And I would tell them the same thing. Like, why would you wait it out? You're going to get appreciation, and then you're going to be able to refinance when it's lower. Then you have a double windfall, and that's like the best. So I think people just need that coaching to figure out that you're not necessarily buying you have to buy with a higher rate, but you could have better benefits later.
Yeah. So you're singing our song. I love it. I mean, that's exactly it. Because a lot of people that we talk to now that are kicking tires, we may want to get a pre-approval, or we want to maybe talk to you about what's available for something that we may, but rates are too high. Okay. Then I asked them this question. I said exactly what you're saying. I go, so rates on a non-loanable condo as an investment property for a short-term rental, we were quoting high 8s 2 years ago, 3 years ago, right? Last year, it was like mid 7s. This year, we're in like the mid 6s. And in certain cases, we can get you into a product that's at 6 or below 6, right? So while you keep waiting, what was the value of that property 3 years ago and what is it today? Right. So you could have got in 3 years ago and then just refinanced today. So you would have had the best of both worlds. You would have had that appreciation in terms of like the market value and take advantage of lower rates now. But as you continue to wait the rate gain, you're losing out on the value gain.
No equity. I mean, you have equity in zero. It's like anything times zero is still zero. And that I think I've always said I don't really believe in analysis paralysis. I just feel like it's a lack of confidence, or they don't have investors around them, or they don't have good partners who tell them, or they think people like you and I are saying like, hey, if you get in now, they think that we're trying to like sell them the pipe dream. And it's like, but appreciation's real. I mean, pretty much if you buy anything, it's going to appreciate in America, unless you just drastically overpay or you pick something with a crazy anomaly that nobody expected. But if you just sit and hold stuff, like Warren Buffett said, you're going to do well. So why not get in the game and see what happens?
Yeah. Get in the game instead of waiting on the game. I agree 100%.
Yeah.
And, to further that, just one step further is the people who took advantage of the lower prices 2, 3, 4 years ago that maybe got into higher rates, they can also look at it. Hey, this one property now can pay for 2 properties, right? Yeah, exactly. Because of that appreciation. Then when I refi, I do a cash out refi, take some of that equity because I can still, passively handle this, especially at a lower rate. And I put that in for a down payment on a new property. Now I got 2 properties working, while some of your peer level maybe just still waiting on, I want the ideal rate. And that's the next question. What is the ideal rate? What's the best rate for you? Realistically, right? Don't come to me with, I want 2% again, right? I mean, that was a one shot in the world, and you were you were alive when it happened, right?
Yeah, but now those people are complaining that they have golden handcuffs and they can't get out of it because the house is too small. It's like, well, I mean, figure it out. Keep it as a rental, or you just got to bite the bullet. There's just not a lot of options. But real estate's so tangible; it does give you those options. I think people get this like weird mindset, like you can never give up a 3% rate. Why? Like we're saying, you have $360,000 in equity. Like it's just what it is. Are your payments going to be more? Yeah, but maybe 2 years later they'll be less.
Yeah,
you can't get all the benefits, cake and eat it too, at all times in real estate. But if you're making appreciation, you can't really ask for much more.
No, I agree with that. And good for you if you've got the equity build and you still don't need to take money out. But if you do need to move, whether you're going to downsize or if you're going to expand in terms of house, the rates aren't horrible. It's not like you're going from 2 to 10.
Yeah. I agree. I mean, I just think it's the younger generation doesn't realize that people like our parents' age were like in the teens, which of course that does sound crazy to me, but you could still get a house on a 30-year loan. That's awesome, because you can't do that in other countries. So there's benefits for all of it. And if you're making appreciation, it's just about whether the payments that you have to make are okay with you. And one thing I wanted to get from you, I've found that people, they get a pre-approval for whatever it is, or they look at the DSR, or they see something and they say, oh, well, I can afford 700. So they try to spend 700. And it's like, you don't have to spend the top so you have no reserves left. That's a terrible idea. Do you find that a lot of people just kind of look at it as almost like monopoly money in a sense?
I do. And also the people, like I'll talk to a lot of our referral partners that are on the realtor and the realtor brokerage side. They'll say, well, we're doing a lot of deals, but a lot of people are either paying cash or they're because they don't like the rates or they're waiting to pay cash. And I look at it this way, and I just kind of just stand there for a second and I go, okay, so even if you were just putting all of your extra savings and money into the S&P 500, and over the last how many, whatever the math is, it's averaging 15, percentage points or 15 points a year, right? Well, then what you're going to tell me is you're going to take 700,000 out of something earning 15 because you don't want to pay 6.
Exactly.
Right. Why don't you just take a little bit for the down payment and pay the 6 and keep the majority of it in the 15 and just keep running?
Yeah, it's very weird thinking. I mean, I'm up 16% just sitting in Vanguard index funds, and I don't even blink. But I mean, I learned my lesson by doing it the wrong way many years ago. It was in 2008 during the crash. I was in Florida and trying to ride out some homes, and I got nervous. But now I've learned my lesson. It's exactly what you said. Why would I take my cash out of something that's doing well when I can get a loan and it can go up and appreciate? Because what like we were saying, what are you doing if you have no asset? You're not earning anything. Right. Hopefully they're keeping it and they're earning the index fund, but you can do both because you can just pull a little bit of the money out.
Right. And then I have I worked with this other client about a year ago now. And so they ID'd this one investment home that they really wanted. It had great rentals. It was a $6 million house down on the beach. It was awesome. And I said, that's great. So they just sold their company. I go, you're going to take $6 million of that and you're going to pay all cash. I go, what if you bought 2 $3 million houses and then you put, $1 million down on each one, and then you keep the other $4 million in the market. And now you got 2 assets at $6 million, right? So, try and work it that way, and you're going to make more money on the rentals. So,
yeah. Hey, it's Jonathan. I hope you're enjoying this episode with Aaron Marsh. And on this brief interlude, I want to remind you that if you're looking for lending and this show is hitting, you might be looking for other things that can enhance your entire real estate portfolio. And one of those for investment properties is cost segregation. If you're interested in getting some knowledge on cost segregation and potentially doing one, call my guy, Sean Graham. You can go to my link at mavencostseg.com/Greene, and Greene has an E at the end. Let's get back to Aaron. Everything is educated risk. I mean, if you know real estate, it's not that risky. You're not buying a $3 million house and you turn around next year and it's worth 1.5. I mean, barring a strange 2008 in Florida, which was fun, but not my best moments. But yeah, I just think it's a fear mechanism that people use, or they watch the news too much, or they just don't want to pull the trigger on things that are easy. But I think when we break it down like this, hopefully it makes it easier for them to start to understand, like, okay, you don't need as much as you think, and you also don't have to spend all the money you have just to get a property. My dad was a cash investor, but it was at a time, back then, no MLS. There were cash deals to be had, and he could get a 40% discount by paying cash. So he just learned how to do it by maximizing the cash and then getting rental properties, and they were all producing. So he did it that way. I think people can still do it that way. They don't have to do cash. But as you were saying, there's a lot of different loan portals now that people can use that can match their goals as long as they're clear on their goals, because then you're starting to build something. So don't you think it's more valuable for somebody new to really spend the time, develop their why, develop how much they really want to spend and what they're looking for, what, as we were saying before, how long they want to keep it? If they come to you and they know all those things, that seems like a great customer, but also a much higher probability of success.
I agree. I agree with all those things. And part of it too is also talk to, someone like yourself, listen to your podcast so you can hear all the different kind of points and kind of become more educated.
Yeah.
And then also call someone like us and then let us kind of listen to what you're trying to do and then work through it. Because I think a lot of people unfortunately watch a lot of HGTV and or like an Instagram reel where it's, a minute or 60 seconds or 45 seconds of someone standing in front of a Lambo going, I just did all this with vending machines. Or I just did all of this. I bought 3 properties. I didn't have to put any money down. It pays me $1 million a month and I'm rich. I think that's probably good advice in terms of thinking, hey, there's an ability to make passive income like this. Now, how do I make that? And what's the real truth?
Yeah. And where's the link to sign up for the course for 6 months to get mentored? I mean, I feel like people should be able to see through this by now. Surprisingly, though, I think social media is a big problem, but I actually think friends who are not real estate investors are the problem a lot, or parents. A kid who's very motivated, has learned a lot, then they go to their parents, oh, you don't do that. I follow Dave Ramsey. You can only pay cash. Or their friend tells them, oh, never get a DSCR loan. They're ripoffs, and they don't understand that that's the only way you're going to get, that 3 family that looks good, but maybe doesn't pencil out the way that you thought in an appraisal. These are things that they take that advice and then you hope they bring it to somebody reputable and say, my friend said this. And you could say, oh, I mean, I see why your friend said that. However, here's the reality.
Yeah. Right. And the whole business purpose side of it, which is in our wheelhouse, is really great in terms of there's alternative ways for you to be able to get qualified and let the property rents pay for the loan. And you kind of open up your eyes. Okay, what is my real exposure here? Do I have any at all? Maybe I don't have any and I have actually income, right? It's the opposite.
Yeah.
And I think, a lot of people have a hard time with the whole, it's the mortgage process. When we bought our house 5 years ago, it was like a bloodletting. It was, full tax returns, full docs. They wanted to know everything. They wanted to go back to, me donating, a bag of clothes to the church and, all that kind of stuff.
We've all been there.
And where it's not that, right? So, we can do 12 months bank statements, right? Yep. We can do DSCR where we're not really looking at any of your financial documents at all, right? And that's kind of foreign. People don't understand that.
Yeah, I mean, I pretty much only get DSCR bank statements, not because I don't have this stuff. I'm just too lazy. I mean, I just don't. I'll take a little bit of a higher rate because I get annoyed of going through that. And like sometimes you have to find stuff that's hard to find or ask things. So I just prefer.
You know what? You're opening yourself up on the underwriting side, right?
Yeah.
The way we always say is underwriters don't unsee anything.
Yeah, exactly.
Right. They want to see more. So let's say you wanted. And you said something that kind of I picked up on is talking about the little bump in rate. So let's say that we can get you a full doc deal at 6% on an investment property, but I can get you in a DSCR for 6.25%, right? and the chasm used to be bigger between what was a primary personal home loan and a business purpose loan. That's really kind of dropped over the last, I would say 36, 48 months, right? That isn't as big a gap anymore. But if I show it to you in a rate stack, and we do this for all of our clients, is the differences, because a lot of people then start to think about, well, 6.25 sounds really high. Like, I don't want to get screwed in this deal, right?
It's like $35 a month.
But really, when you look at it, and we break it down for you, the P&I on it is like $150 a month, or it's $100 a month. But what is the difference? Well, the difference is I only had to show that the rents were going to cover what I needed to cover. And I didn't, give them all my tax returns and then have underwriting going through, well, you got this and where's this and when they need that, right? And the same thing with I always use an example. I have a client that has 17 LLCs. Going to the bank with 17 LLCs, good luck with that.
Yeah.
Right? Because it's just, number one, they didn't want to talk to you. And then two, if they do, their underwriter is just going to go into a wormhole.
Yeah. And one of the things that I feel is very unknown, especially to real estate agents who are trying to help people get investment properties. There's very few who are really investor friendly like myself. But I feel like if you understand DSCR loans, you understand what properties are going to be very, very good for DSCR loans. Like if you see a very high rent roll across the board, you're like, ooh, that looks good. Or even you see a short-term rental, but you know that the long-term rent is extremely solid. You're just lining yourself up for DSCR, the easiest loan you've ever done. Am I right?
Yes. Yeah. And just so everybody get level set, and I'm sure they already know, but a DSCR is just kind of like a seesaw, right? So I put 4 things on this side. I put the P&I or the mortgage payment, plus the homeowner's insurance, the property taxes, and if there's an HOA or condo association, you add those 4 together, and let's say that's $5,000 a month. If I have rentals over here, that we can, be a gross rental at $60,000 or above, then a lot of times, that just checks the loan. We haven't looked at your tax returns. We haven't looked at your bank statements. We haven't verified your employment. We haven't do any of that kind of stuff. So then now we're off to the races.
Yeah. And even for my personal residence, I just did bank statement loan because I was annoyed, or I hadn't finished. I had an extension on my tax return for that year, and they're like, oh, you need it. And I'm like, I'm not going to finish it anytime soon. So, and it's funny though, because we were talking about the rate differentials then. It was time when rates were mid 3s, and I got a very low 4s. And at the time I'm like, damn. And now I'm like, great job. That 4 is good. And that taught me a lot though about what we were saying before. It's you never know what's going to happen, but rates are very fine right now. I don't even see them as a big problem at all.
I don't. And I think careful what you wish for. If you go back, and we bought an investment property during this time, when rates get highly attractive or to a level or dip below a level where people think that's a good rate, whatever that number is, 3, 4, 5, 5.5, 6, then the demand goes way up. And then now you've lost where you thought you had buying power in terms of a lower rate. You're now losing it on the sell side because now they're getting multiple offers in, right?
Yeah.
And then it goes back to those days of, every time you go with a realtor to look at a property, whether it's an investment property, a single family residence, whatever it is, they go, well, you got to hurry up and make a decision on this, and you need to be 5% over because they already have 3 offers,
Yeah. I mean, I'm in New Jersey. I'm in a market where things get 20, 30 offers. They sell 500,000 over, $1 million over. This is not an exaggeration. These are residential markets with that. And then we tell people who aren't ready for it, and they're like, oh, that's not going to happen. And then I just send them evidence of here's the 5 that sold for $1 million over. I don't know why it's happening, but it is. So, sometimes it's underpricing, sometimes it's heat in the market. But part of that, again, goes back to being prepared, making sure that you're ready to get into the game and understanding the loan portal and talking with your lender, knowing what your obligations are going to be. That's the most important part. I mean, I just think it's a puzzle where all the parties really have to be on the same page, but it's hard because the majority of real estate agents don't know anything about investing. And then they're just connecting to a regular residential lender. So I feel you always get this kind of weird speak that investors don't like agents. It's just because most agents don't know what they're doing. And most lenders aren't qualified to do the types of loans that they really need. So they end up with loan portals that they never really wanted.
Exactly. I agree with everything you said. And that whole education piece kind of is really the part that myself and a lot of people in my peer group that we try and do is we want to be partnership / relationship based businesses, not transactional. And what you're describing is a realtor's I don't know. I don't care. Just call this bank. That's the guy at the bank that always does everything. And when can we close? You close once, but you could own the building for the rest of your life. Right. So get it right.
Yeah, absolutely. What do you think the biggest mistake that borrowers are making in terms of getting prepared to buy a property?
In today,
Yeah.
in today's market, I've been talking a lot with, people that kind of ask me this question is, it used to be a one-to-one relationship, right? It was us and the client. And now it's like us, the client, and Chat GPT.
Oh,
Where Chat
same. Oh,
GPT
the worst.
is a good tool. It's not your solution.
Yeah.
Right.
Tool is a perfect term for what it is. It's a tool in the toolbox without humans.
And what happens is our side will do a ton of work, right? And we'll be working back and forth with the clients. We'll be, getting documents. We'll be working with 2 or 3 lenders to strategically get the best rate at the right terms, and the best product with the down payment that they want. And we'll put it all together and say, hey, here's our recommendation. And it's 30 days to close, and let's get the appraisal going. And, you're looking great. You're looking good. And they'll just go, okay. And they'll take that email with all that information, they'll throw it in chat, and their prompt will be, can I get a better deal?
Exactly. And it's all in the prompt.
It could be like chat doesn't even know what you're bidding on, right? And so chat's answer is always yes, right?
Exactly.
They're
there to please you.
Ask chat something and it says no.
We've had a lot of problems with people putting their inspection reports in and then asking, and it's like, what's wrong with this? Well, now it's going to tell you everything that's wrong. It doesn't tell you that none of that stuff is really wrong and it's all cosmetic and you have a limiting provision and you're not getting any of that. So I've actually fired several clients just this year for using ChatGPT and like asking me about, and I tell them straight out, not to be arrogant, but like, I'm ChatGPT. ChatGPT is a different thing. I'm like the human version. I've been walking houses since I was 2. Ask me the questions that you want. If you put it in there, it's really for you to learn. It's not for you to come back and ask me unless it's a really good question. But don't question what I've told you based on all my years, because you fed it in with a very poor prompt with no background in the chat at all. Like it has nothing to base it on. They just don't understand.
Yeah. And then it'll come back with some stuff that's just garbage anyway, right? So, we do DSCRs all the time. We know what the sweet spot is in terms of down payment.
Yeah.
Right. And they'll go, well, we want a DSCR because, we found out that there's DSCRs that are 100% financing and there's no down payment.
Yeah. Okay.
I go, okay, let's just forget chat for a second, just because it found some, Instagram thing that said, hey, 100% financing on DSCR that someone threw out there. Right. But it's, let's think about this. You think a bank's going to give you a loan
right
without looking at any of your financials at 100% of the leverage. And that's okay. Do you think that?
And also 6%.
Huh?
Also 6%.
Yeah, now we're back to 2008, right? Yeah, we'll throw in all your closing costs too.
Right.
We'll pay everything.
Yeah. No, I mean, I think that's part of the problem. And look, real estate investing has become, more socially acceptable in terms of it's all over social media. There's a lot of fake gurus in the space, so I know why people get snowed. But you have to, over time, I've always said, podcasts are a great way to vet whether people know stuff, because if you can show up and talk for an hour, you know what you're talking about. Just look for that person on a podcast as a guest and you'll realize, oh, okay, they don't, there's no breaks for notes. Like we just publish the episode. It is what it is. You have to be able to answer. And if you get yourself prepared with ChatGPT, I think a good thing to use it for is to be like, what are the 5 best questions I should ask a lender when I'm going to get a DSCR loan? That's at least going to give you much better questions. So then you get better answers. You don't ask them the things like you're saying, can I get a better rate? Yeah. I mean, in the history of the universe, is there a better rate? It just comes with different terms.
Right. I can get you a good rate. You're just not going to like what it costs to get it.
Yeah. Yeah, exactly. Right. Sure. You can get that 0% down, 100%. You're going to pay 19% and also have to have collateral.
Yes. Right.
Yeah.
And And I think that just like you said, if you can refine it and just figure out, how do I become more educated about an investment property? What are the 10 things I need to look at? What makes an investment property the best? Is it heads and beds? Is it amenities? Is it proximity to the beach? Whatever it is, right?
Yeah.
Those are good questions. But like you said, can I get a better deal? Can I get a lower down payment?
The answer is always yes.
Yeah, the answer is always yes. And then that causes, like what you talked about earlier, was the analysis paralysis.
Yeah.
There's a lot more analysis paralysis because people, are trying to get into their 8th iteration of a chat answer. And now the thing just becomes confused.
Yeah, I mean, I say the same thing. I just did a whole episode on why you need to get off real estate spreadsheets. If you want something not to work, you'll find a way to not make it work. So if you're scared of doing a deal and you just keep iterating in chat, it's going to tell you it's a bad deal because that's what you want. If you want, but the other way, if you want to make a deal good that's bad, you can just erase the vacancy percentage or erase the capex. It'll work. But that's why you need humans in the middle. Like I do like AI. I use it. I've learned to use it better, but I think people need to do it as well. It's not there I mean, are there people in the world that you want to double check stuff? Yeah, but I think they're just not using it the right way, as we were saying. If we go to the other side, or we're thinking about like what you like to do, you guys have a lot of different products. Is there a specific asset class that you enjoy lending on right now?
We've been getting more and more commercial deals. That's for sure. The multifamily piece is starting to come back up again.
Yeah.
Because the multifamily piece is a little bit of chicken egg, right? So people are hesitant to go buy a house because they're waiting on rates or they're waiting on prices to come down, or there's a lot of talk about affordability. So they just keep renewing their lease and their rent, right? So there's a lot of attractiveness in some of that multifamily space. Our sweet spot, just because of where we are and what we do a lot of, is in the investment home for short-term rental or long-term rental, but mostly short-term rental.
Yeah.
So the whole Airbnb, VRBO, property management groups, that kind of stuff, that just tends to be a really place where we play well. We have a lot of experience in it, and then we've put ourselves in a portfolio of lending partners that are really good at it. So they have, kind of what I call the income stacking or asset stacking piece of it. So let's say you're looking at a property and it's just not quite there on a DSCR, a 1.0 ratio to get, the best rate. Well, maybe it comes in at a 0.75. There's a little difference in rate. You could go there, or to get you over the hump, maybe we'll take like you have a large 401k that'll help, offset it, or you have like a Fidelity or Schwab account that has a little bit of money in it. And then we're not saying that we have to use that money, but it's there to help check the box. And we still haven't done the deep dive into all your tax returns and everything like that. So we've curated a pretty good portfolio across the board on that. I would say the other thing that we're getting into is a lot more on the ground up construction spec property build. So, it's either build to rent or build to sell.
Yeah.
Right. And so we're working with a lot of good lenders in terms of, how do we offer capital to these spec buyers that are building the houses and then are going to start during the pre-sale process during the build. So that way, when they get the CO, then they can close, and then the new owners can take it over either as a primary, or they'll take it over and turn it into a rental.
Yeah. Do you finance like the purchase of the land for then the future development, and then you give them also a construction loan? Is that part of the process?
There's really kind of two distinct ways of doing it. We have lenders that will do that, right? So they'll, like, let's say you bought a piece of land, you put 50% down on a $100,000 lot, you owe 50,000 to a bank or something. So they'll come in, they'll take out the bank, that 50,000, and add it into your construction budget, and then just make the math work that way. Or there's also, really, to get more attractive terms, is if you own the land outright. So let's say you paid the full 100,000 for the lot, you're sitting on it while you pick your general contractor and your architect or your plans, and you're getting your budget and permits together. then lenders will come in because that's your skin in the game. You already are in for that. So there's no extra down payment.
Yeah. Yeah. Build to rent was really hot for a while. I said it's cooled off a little bit, but I had somebody on not that long ago that it was both for new development sales and build to rent, that a lot of builders had overshot in two markets that you know very well, Florida and Texas, in terms of they were building homes that were just too big because now affordability is harder. So it couldn't really catch up. That's why there's so many discounts in Texas specifically for rentals, but there's like a disparity in terms of how much space you need and how much it can cost and what's a giveaway cost on that. Have you seen that on the lending side as well?
Yeah. And has there been some overbuilding? I would say yes, in terms of like what you were talking about, the too big of a property as you're trying to get it. But then also I look at it too is one thing you have to think about is the dollars per square foot to build is not the same as the dollars per square foot to sell.
Yeah.
Right. And so that gap is still big enough, even if they have to discount it under market, there's still enough profit that's in there that makes that attractive. I tell people all the time, you can buy a turnkey rental property, whether it's a condo, a duplex, a multifamily, and you'll start making passive income right away. And that's how much you get. And then the fix and flips where you come in, and if it's an easy one where it's not heavy rehab and it's just paint and pillows, then you're making a little bit more because you bought it at a lower dollars per square foot than market, and you're going to sell it at market 12 months later, right?
Yeah.
And then if you have some time on your side and you have 12 to 18 months on a build process, your dollars per square foot to build and then what you can return on investment when you sell it is much greater.
Yeah. And I think even if technically some areas were overbuilt, I still don't think that's not going to be a problem long term. Eventually, someone's going to have to move the needle so that it works because we need more housing. So it's not like housing is going to sit vacant. Someone's going to figure it out at some point, and either move the price down or someone's going to be able to get up to that price if rates come down. But going back to what you said before, yeah, I think they said every time rates go down 1 percentage point, that's 1 million more buyers in the market. So as you were saying, that if you may get what you wish for, great, you're going to have a 4% rate, but now instead of bidding against 4 people, you're bidding against 9.
Right.
And
like you said, you could quickly get into a situation where, like you said, where you were at, where people are paying $500,000 to $1 million above market. Well, what happens? I mean, water seeks its own level. So when they flip the switch and rates start to creep back up and market value starts to come down on houses, then you could be in a situation where now, you're not getting that organic appreciation fast enough because you paid a premium to get into it.
Yeah. Yeah. I've seen it all the time. We look at it and I'm like, I understand why you're going to pay that much, but like you're not hitting your value and they're waiving appraisal if they have a mortgage. So it's like, you're not hitting that value for 3 to 5 years. You'll hit it probably, especially because there's more in the area. An area like that, it does develop the comps pretty quickly. But I think if people understand that, they know what they're doing if they're trying to get into it. And if they're trying to get into an investment property, we're just saying, one of your specialties now, short-term rental, it's really important. It's much more complicated than people think. I feel like it's such a hospitality industry now that we're going to see, especially in your game, you're going to see much more experienced operators doing better. And then you're going to see the people who thought they could do it struggling on their loans because they just did a very average Airbnb and it can't match up with the other ones that are coming into the area that are just going to knock them out with better performance, better operations, better amenities. It's an interesting time to be in short-term rentals. We saw a lot of people who got in during the pandemic, just like not being able to keep up with the new operators. Have you seen that?
Yeah. And I think one of the keys is understanding if you're going to do this yourself, it is a job.
Oh yeah.
Right. And especially if you don't live within a proximity of the property. So a lot of our buyers and investors don't live here. They live states away. Right. So let's say it's someone in Dallas who bought a property here. you need a really strong property management company because they have all the subs, right? So every time that you're turning that, especially in the summertime, you got to have someone that you can count on, a cleaning crew that's going to come in and make that thing look brand new.
Yeah.
And then any maintenance stuff, the landscaping, the all of it, right? And you got to have like subs on call in terms of if you're trying to manage yourself, and you got to market it, right? So you have to get and a lot of the property management companies that we refer to, that do a great job at like the marketing piece, and they have a built up database over time that their clients just use them, and a lot of times go back to the same house every year because they start to feel like it's their house. But it's hard to do if you don't know what you're doing and you don't have like the time to put in the marketing of your property, like getting it out there so people can find it.
Yeah. I mean, that's where the problem is. You get a property, it works on a DSCR, but then you put in $100K to put in all the amenities that someone told you, but you don't know how to run it. So you underperform, or you have bad pictures because you don't think it matters. And now you can't compete with the marketplace. Now your projections are all off, and now it doesn't seem like a good deal, but it's really, I think a lot of real estate complaints are just user error. People who just thought they could do something and then realized it was too hard, which is a lot of real estate investing. Like you were saying before, someone watches a TikTok and they're like, oh yeah, I'll get 6 Section 8 rentals. It's like that's for experts. It's not for new people. Just like flipping houses isn't for new people unless you're really trying to break even and learn so you do better the next time. And again, I mean, I think if you go back and you take a cross section of all the things that we've talked about, it's really about finding people that you can trust in the business, realtors, lenders, title companies, attorneys, so that they're all able to work together, because that's when you make the best deals, right? You get a good referral from your partner or the realtor. The client's nice because they've been vetted by the realtor. You do a good job, and then you continue that cycle. I basically have one lender to refer to, one title company, one attorney, and one home inspector. And everyone's like, oh, you should send 3 to everyone. I'm like, these are the best. They're not going to fail me. If something goes wrong, I'll take the hit on that. But I think that's the best way to go, don't you? I mean, that's why you saw your grandmother and your mom grow a real estate business back then. I'm still working the same way, and it seems like you are as well.
Yeah, I mean, we do a ton of organic stuff. We're tied in from a grounded level, right? So not everything we do is all digital, right? So we spend the time. We want to make sure we go to open houses, and we don't go in there and say, just give me all your deals, right? I mean, that's something that we don't do. We go in and we say, hey, tell us about your pain points. Tell us about your last lending thing that didn't close or didn't work out.
Yeah.
What happened, like how, and we're there to offer value, because the more deals that they close gives us more swings at the bat. Right. And that's, I mean, I still say partnership still wins out in this business, as opposed to just raw technology driven, transactional.
Yeah, I agree.
I mean, there's always going to be an appetite out there that someone is going to be like, I'm going to buy this $700,000 house and I'm going to put down $100,000 on it, and I'm going to do it all through AI, and I'm never going to talk to a person.
Yeah. There's like articles come out.
But that's not the majority. The majority is not there yet.
It's not even real anyway. I've read a few articles of people like, I closed a house just with AI. It's like, that's not really what happened. And just wait a couple of years and see how you like it. Awesome, man. Is the best place for people to find you? I know you lend in 34 states. Is it at marshlending.com?
Yeah, that's our website. And that'll kind of give you a start. And then we have an entire panel series on our YouTube channel, which is at Marsh Lending. And it's all about investments. We kind of break it down from all sides: the investor side, the brokerage side, the property management side, and the lending side. So there's a lot of great information there.
Yeah, and I think YouTube is a very valuable commodity because it's longer than the things that we're talking about. Like, you can watch a 20-minute video, you're going to get a lot more value out of that. And similar to a podcast, you'll be able to really get a better idea. Like, does this person really know anything? Like, you can tell when something's been cut up 100 times, and then you can tell where it's like, hey, I'm just going to record 20 minutes and here's good information for you.
Yeah. And I think, and like what I use podcasts for a lot of times is during my walks and any of that kind of stuff. I mean, you throw in a podcast just like this and you do a 45-minute walk and look at how much, gold that they came out of this podcast.
Yeah. And you get some exercise. I mean, what's bad? In the car, all I do is listen to books and podcasts. When I'm walking, all I do is books and podcasts. It's just it's a great way to just shovel more information into my brain.
Yeah.
Awesome, man. Well, really appreciate you coming on. It's been a pleasure, and I'll send people your way.
All right. Well, thank you. And I'll do the same. I appreciate you.
Yeah. All right. That was Aaron Marsh. He's the president of Marsh Lending. Again, you can find them at marshlending.com. I'm Jonathan Greene. We'll see you next episode. Thanks for sticking around to the end so you can get a preview of who's coming up on episode 362 of Zen and the Art of Real Estate Investing. It's Stuart Heath. He's the founder of Harvard Grace Capital, and we're talking syndications, asset classes, and commercial opportunities. We talk about a variety of asset classes, but we also talk about how Stuart's buy box is geographical. We'll see you next episode with Stuart.